Hello everyone, in this video I'm going to teach you a powerful setup that I've been using to trade NQ on different financial markets. I name it the Fénix setup. It is a complicated model and yet a simple one if you understand the basics. This model is based on market structure, so if you haven't watched my free YouTube videos about market structure, pause this video and go watch it. This setup will provide you with a high risk to reward and a larger moves like 50 to 100 hand. It works on every time frame, but better use it on a higher time frame like 1 hour and more to catch like good home runs. I shared this setup a few days ago in Twitter, and I'm going to talk a little bit more about it. Then after that we're going to see two examples on the charts. So this is the same setup, okay, and the only difference is what's happening here after mitigating this zone. Okay, so we have a downtrend here. Then we're going to see some speed going on in here, taking this high, the high that brought all the price down in here. And after taking this high, we're going to make another high, then making this low, and this low will be responsible for taking that high. And after that, people will go long in here, long in here, long in here, or long in here, trying to catch another move up, which is not correct and not good and not the way to trade the market, because you will get wrecked and you will get liquidated. And if you force it, for example, trying to trade here and here, you're going to get fucked. Okay, whatever. So why, after putting that high, we're trading exactly here, then making this high in here? Because on lower time frame, or even on that same time frame, you're going to see some flip in here. This is a zone, so usually we trade to this zone and trade lower, but you see that we're breaching that zone, so we come back and use this same zone as a flip. We're going to use that to trade this. So this is a quick scalp like SBS or like Stoic have been teaching. It's quick scalp to take this high, and this is the first sequence. Okay, after that we're going to come back to mitigate the unmitigated zone in here. And you need to know and you need to watch closely what's happening after breaching the zone. If we're going to trade in here or in here without mitigating the 50%, so you want to see price trade below the 50% and even at the 70. But if we don't trade after breaching the zone, if we don't trade again in the zone and then trade higher, you want to go long after reaching the 50%, and it will reach the 50%. Or you want to wait for the move to happen and then some pullback, you trade higher, and then you're going to take this zone and go long in here. Alright, so the difference between this and this one is that you will see here something like this. So in this case, I don't want to trade at the 30%, but I will wait to trade below the 50%. Like this. You can go long in here if you have the right context, but if you want to be sure about your entry and you need some other confirmation, you need to wait for this move to happen and then some retracement, and you go long in here. Alright? So if this isn't clear, you're going to see the same thing happening in the charts. So I want to do this as a long and this as short, right? So this is the first example that we're going to see. So we're having this high, alright, that got breached in here, okay, and this is the trend, the bearish trend that was going, and this is the high made after this important high. All right, so I'm gonna take the first zone responsible for all of this move down, and as you see, when we traded above and took that high, we came back exactly at the 50%, and you can trade at the 50%, taking, for example, this. All right, it is a good 1 to 3 risk to reward, okay, but if we're going to use the rules of 30, 70 and 50, you will trade at the 70. Why? Because after coming back to the flip zone in here, we traded above, left the range and then came back. So I'm not using the 50, I will use the 70%. In this case, I will trade from here with the lower stop and will target this high. Alright, so after we make all of this move up, now we wait for this unmitigated zone to be mitigated, which happened in here. You see that we traded to the in the zone after leaving the zone and made another high. We traded back again, made another high. So you won't go long here at the 50 but below the 50, which is here. And in this case, why we didn't trade exactly at the 70, it's because we had this unmitigated zone in here. We tapped in at the 50% of this zone. So you want to take this and trade at least to the high that brought price to mitigate this entire zone, and you want to have another one to target this high in here. So this is the first entry. If you know what you're doing, this is the first entry, and you have another entry which needs like more confirmation, and you want to see price going in your favor and giving you another opportunity. Like, it's not risk-free, but another opportunity that shows you that price is going into your target, which is here, right? The setup that I'm trying to teach you, I want to target this high. All right, if we made only this high and then came back to mitigate the zone, I will target this high, but we made that high, and this is the high that mitigated all of this moving here. And in this case, for the second entry, you see that we have a hidden S&D in here, and the hidden S&D will act as a zone or as a flip zone. So after we breached that hidden S&D and closed it above, we came back at the 50% and you want to go long in here and target this high. That's the setup. So in this setup, how many trade you could have? You have one quick trade and you have one in here, and you have the same one if you want to leave some runners to this high. So you have 1, 2, 3, 4 trades, and all of these trades have a good and huge risk to reward. So in this case you have 5 risk to reward, here you have 7, here you have 15, and here you have 8. So you can trade this setup like 3 times. You have the first scalp, you have the second one, and you have you have this, and you have also this. So this is the way you can trade this setup when we trade below the 70, below the 50. Now let's see the second scenario, which is in taking the trade in the shorts. So we have this high and we have this low, and we breached the low in here, right? So the first thing to see is that we're having this flip in here, and this is the first flip that brought price to here, right? And we have in this high, and this is the first very low that happened after taking this high. So I'm going to put this in here. So remember, the first trade is to go short after mitigating the flip and target the last low. And in this case, after trading below and closing below this zone, and this zone will become flip zone, we traded slightly below the 30% and traded below. So we're not taking the trade at the 50, we're taking it at the 70. So this is our first trade at the 70. We're targeting this. Alright? And we're going to wait until we mitigate this zone, and then we're going to trade lower. Took some time, and we took this low in here. We're having another low. So we traded exactly at the 50% in here. So the first trade starts from here, and we're targeting this low. Alright? Or you wanna wait for another confirmation and in this case I'm going to use a lower time frame flip zone, which is this one from here to here, and you can enter with lower risk trading till here, and this is a huge risk to reward. You can enter here, here, or here after seeing all the confirmation of the trend going in your favor and in your way. So you can enter here, here after tapping the 50% of this flip, or here. Watch what happened. We traded all the way back into this. So this is why I like to use this setup for higher time frames, because it gives you, if you know what you're doing, it gives you a high risk to reward, but you need to be patient. Like really, you need to be patient. Like, and you can trade and take another trade when you are waiting for your setups. For example, in here we have this zone. We still didn't flip it in here, right? So for example, we traded above, traded at 30, didn't mitigate fully the zones, and we traded above. So we want to wait until we trade to the 70, and we going to trade and to take the high that brought price to mitigate the zone, which happened here. So you can trade this one and target this high or this high. Okay, and remember, you don't need to overcomplicate your trading plan. Everything is simple if you know what you're doing. You just need patience. You just need to sometimes to zoom out and see what's happening in the market structure in the higher time frames, so you can align yourself with the right bias. So this is to show that simplicity doesn't mean that you don't know that much or you don't do that much. Simplicity is gathering a lot of information and compressing it to simple and small things that do better than having a lot of confluences. Like I need a bearish order block to break a block to block. You know what I'm trying to say. This is the SpaceX engine, and you see the Raptor 1, the Raptor 2, and the Raptor 3. This just to say simplicity is better, and this is the way I will end this video. Please go backtest, please go study this, because if you don't do that, it won't mean a thing